Why does the economy feel like a house of cards right now? I mean, you turn on the news, the stock market looks totally fine, the official numbers are going up, but talk to literally anyone on the street and there's this heavy, lingering anxiety. It just feels broken, right? Kinda fragile?
Yeah, and that is exactly what we're unpacking in this explainer. We're going to decode those hidden systemic risks that are just lurking beneath all that official data. We've got data from the Reserve Bank of Australia on the 2008 crash, plus some really fresh market analysis on the actual state of our financial system today. So let's just dive right in.
All right, Section 1, why the economy feels fragile. Because look, we've been told a recession has been fast approaching for years now, but somehow, on paper anyway, it never quite arrives. And that brings us to this incredibly stark paradox. On one side, you've got the official gross domestic product, GDP, and it's growing at a nice, steady 2% a year. But on the flip side, credit card delinquency rates are suddenly hitting their highest levels since 2008. See, that right there is the disconnect I'm talking about. We are constantly told everything is fine, but consumer sentiment has just totally plummeted to record lows. Like, if the economy is actually growing, why can't people pay their credit card bills? Well, the sheer scale of the problem here is just staggering. $42 trillion. That is the total private debt in the United States right now.
Wait, hold up. 42 trillion? Isn't that, like, almost double what it was right before the 2008 crash?
It is, yeah, almost double. And what that proves is that the economy's foundation is built incredibly heavily on borrowing. This isn't organic growth. It's growth completely fueled by debt. And when you have that much debt sloshing around, the whole system becomes hypersensitive to even the tiniest little shock. Which brings us to Section 2, the banking system Jenga tower. Because honestly, with everything propped up by debt, it really does sound like a giant game of Jenga. How does the system even function beneath the surface? Jenga is actually the absolute perfect analogy for modern banking. Let's look at why that tower is getting so incredibly wobbly. It really all comes down to this core mechanism called fractional reserve banking. Now, this isn't some secret smoky backroom conspiracy. It's literally just how the global economy operates. Banks only hold a tiny fraction of customer deposits on hand, and they lend all the rest out to generate a profit. Okay, so just to be super clear here, a massive chunk of the economic growth we experience, it relies on banks handing out money that they know they don't actually have sitting in the vault? Exactly. The entire global financial system rests 100% on collective trust. It just assumes that, well, not everyone is going to want their money back on the exact same day. But what happens when that trust just snaps?
Right, so here's how the disaster plays out. Step 1, the bank makes risky bets and takes some losses. Step 2, depositors get spooked and start panic withdrawing. Step 3, the bank completely fails. It's an elegant system, honestly, until everyone realizes the emperor has no money. And this is not just theoretical. Look back at the 2023 collapse of Silicon Valley Bank. Once word got out that they were sitting on massive losses from rising interest rates, fear just totally took over. Depositors pulled $42 billion in a single day.
$42 billion in 24 hours. I mean, there is no way a bank survives that. That is literally fear pulling the absolute worst block from the Jenga tower and watching the whole thing crash down. Moving on to Section 3, lessons from the 2008 crash.
Yeah, because hearing about Silicon Valley Bank immediately makes me wonder, are we heading straight for another 2008 right now?
It is the million-dollar question. And to answer it, we have to compare today's vulnerabilities with historical data. The Reserve Bank of Australia actually mapped out exactly how the 2008 global financial crisis unfolded, and man, the parallels are pretty eye-opening. If we track the anatomy of that 2008 crash, there's a really clear pattern. In the years leading up, we had this super favorable macroeconomic environment, but with crazy excessive risk-taking and virtually no regulation. Lenders were just handing out massive mortgages to subprime borrowers without even checking if they could pay them back.
Right, and they did that because they were packaging those toxic loans into these incredibly complex, opaque mortgage-backed securities and just selling them off, right?
Precisely. Fast forward to mid-2006 and U.S. house prices start to fall. Borrowers start missing payments. By mid-2007, investors finally realized these quote-unquote safe mortgage-backed securities were completely toxic. And then, boom, September 2008, Lehman Brothers fails, and it triggers a total global financial panic. It is so easy to get lost in all the abstract jargon, mortgage-backed securities, liquidity crunches, global spillovers. But let's bring this back to reality for a second. During that crash, the residential construction sector alone shed nearly 40% of its entire workforce.
Yeah, the real-world impact was just devastating. It wasn't just numbers on a screen falling, it was a catastrophic collapse in everyday consumption.
Exactly. Real everyday workers, tradespeople in places like Arizona, Nevada, Florida, they literally saw their livelihoods vanish overnight. And when they couldn't spend money anymore, the local restaurants failed, the hardware stores went under. It created this totally vicious cycle of unemployment. Which takes us right into Section 4, today's new economic warning signs.
So, if bad housing loans were the trigger in 2008, what are the new subprime mortgages today? Like, what are the hidden tripwires threatening the global system right this second?
Well, today's vulnerabilities definitely look different than housing, but the underlying mechanics, the excessive leverage, the crazy risk, are remarkably similar. Let me throw a staggering number at you, $121 billion. That's the amount of money just the 5 largest tech companies are projected to borrow in 2025 alone, specifically to fund their AI investments.
Wait, big tech is borrowing that much? I thought those guys were sitting on, like, dragon hoards of cash.
They are, but capital investment in AI is accelerating so unbelievably fast. We're talking nearly doubling in a single year that they're increasingly relying on borrowed money to keep up. And think back to our Jenga tower. The banks lending out those billions are using other people's deposits. If the sentiment around AI shifts and these massive bets don't turn a profit, that could trigger catastrophic losses across the entire banking network.
And if a crisis does hit, we are staring down another massive problem, $1 trillion. That is the current annual interest payment on U.S. government debt.
$1 trillion just on the interest? That's, what, more than the entire U.S. defense budget?
It is. Historically, every time the government has stepped in to rescue a failing economy, they've borrowed massive amounts of money to do it. But back then, borrowing was incredibly cheap. Today, a government bailout would be exponentially more difficult and so much more expensive.
So the really terrifying point is laid out right here. In 2008, that massive emergency stimulus package cost the government about $75 billion in interest over a decade. If they had to run that exact same stimulus package today, at today's interest rates, it wouldn't be $75 billion. It would cost $1.35 trillion. That is 18 times more.
Wow. That paints an incredibly bleak picture of a fiscal doom loop. If the economy crashes, the government has to borrow money to save it. But bond markets get totally spooked by all that new debt and demand higher interest rates. Those higher rates then explode the national deficit, which means they have to borrow even more. So literally, borrowing money to save the economy actually makes the crisis worse.
All right, Section 5, the real-world impact on you.
Let's definitely bring this directly back to the people watching this explainer. How is all this macro-level fragility already showing up in our everyday wallets? Because I guarantee you, people are absolutely feeling it.
They are for sure. Let's look at exactly what's draining those wallets. If we break down the real drivers of this debt, since 2020, the cost of basic groceries is up around 25%, and across major cities, average rents have skyrocketed by 40%.
And let's be real, wages absolutely haven't kept pace with a 40% hike in rent.
No, they definitely haven't. And to fill that massive gap, American families have been forced to take on an extra $10 trillion in debt. This is exactly why those credit card delinquencies we mentioned earlier are surging. Effectively, for millions and millions of families, a personal recession has already arrived. It just hasn't officially registered in the big national GDP data yet. But here is a really fascinating, kind of surprising twist about what the next macro-level crash might actually look like. It might not be some sudden, fiery explosion like Lehman Brothers in 2008. Instead, it could look a lot more like the 1990s in Japan, the zombie firm era. A slow, drawn-out economic stagnation. Break that down for us. How does that actually work? So in Japan, when their massive asset bubble burst, the government intervened just enough to prop up all the struggling banks and keep failing companies alive by feeding them cheap credit. These became known as zombie firms. Now, it prevented a sudden, terrifying crash, and it kept employment relatively high, but it completely strangled productivity and incomes for literally decades. The economy just flatlined. Which brings us to our final section, Section 6, 3 key takeaways to remember.
Yeah, we have covered a massive amount of ground today, from fractional reserve banking and AI debt all the way to fiscal doom loops and Japanese zombie firms. Could you just cut through all the noise and boil this complex data down into the absolute essentials?
Absolutely. Let's distill all these implications of global financial fragility down to the 3 big things you actually need to remember.
Here are your 3 key takeaways. Number 1, systemic risk. Always remember that our entire economic engine runs on trust, and on banks lending out money they don't actually have sitting in the vault. Number 2, the fiscal doom loop. Unlike back in 2008, surging interest on government debt today makes any future bailouts dangerously expensive, which really limits the government's ability to save us from a crash. And number 3, the stagnation threat. The real danger to your savings and your future might not be a sudden dramatic wave of job losses, but rather a slow, invisible stagnation, where your income stays perfectly flat while the cost of living just keeps grinding higher.
Which leaves us with this really stark, lingering question for you to ponder. Will our next crash be a sudden, dramatic collapse, or a slow, invisible stagnation? As we've seen from all the data today, economic forecasters rarely predict the exact timing of these things. I mean, they missed 2008 completely. But the underlying vulnerabilities, from massive private debt to skyrocketing basic costs, are undeniably real. Thanks so much for joining us for this explainer. Keep questioning those headline numbers, and we'll see you next time.